Joining me, Dan Genter is the CEO and CIO at Genter Capital Management. Dan, welcome back to the show. So when you're talking with clients right now, what's the conversation like? Are people just eager to get in on this AI trade, or are they worried that it's going to betray them at any moment?
Well, they're still eager, Oliver, to get into the trade. I mean, right now, a lot of people that haven't been participating feel they're being left behind. I mean, it's obviously that's where the horsepower is in tech right now. That's what's being driven. And it's still you can do no wrong, basically riding the AI train. So we're hearing about it from clients. Frankly, the thing that concerns me a little bit is now we got the 80-year-old grandmother that's calling us up and wants us to buy Nvidia in the portfolio where she's all high dividend or bond portfolio. So it might be getting a little frothy right now with people that are coming on the train. It's clearly out of the station at this point.
How do you think about risk as the shape of the market has changed so much around this concentration, Dan? We just heard the case from the Morningstar team about kind of shifting more towards the value and the underperformers, which seems like a very reasonable take, but there could be an opportunity cost if AI is just gobbling up all the productivity. So how do you kind of weigh the risk of a highly concentrated market and the possible opportunity cost of missing out on trades like this?
Look, there's so much momentum there now. You cannot exit it. I mean, literally, you're trying to not only jump off of a speeding train, you're trying to jump off of a speeding bullet train. And so you need to stay in. We think that the key, though, is just not get too overweighted. I mean, you're looking at if somebody had a 3.5%, 4% average position, for example, in Nvidia, well, many of them have 10% positions now. And that's just too much. I mean, you saw the same thing when people got caught in the Tesla trap. So it's a perfect indication of you can just start to pare back, take some chips off the table. Nobody ever got hurt in doing that. And don't get out, but just don't be overweighted. Bring yourself back to a 5% position, take some of the profits, rediversify into a few areas and individual stocks that have been left behind. And it's just you don't want to make the amateur mistake of just riding your winners up until the point where they're not winners anymore.
Yeah. One last question on that, Dan, which is when the split happens, I mean, are your phone lines going to be going off the hook? How will you handle that? And do you think that changes any of this as it becomes more affordable on a price per unit basis?
Well, look, I think that the individual investors we have are generally not as focused on the individual issues, and they really more or less leave that to us. But the fact of the matter is, if we have some significant downturn in the Mag 7 or other areas, it's just going to there's such a big weighting right now in the major indices. It's going to get a lot of news. It's going to hurt all the indexes, and clearly you're going to have to answer questions about that. That's why we think staying diversified is just such a key. You just don't want to give that all back right now. And it's been a good ride, but let's take a little bit off the table.
Okay. You're looking at some of the unloved tech as maybe a way to play a little catch up since we're in the conversation about value hunting from the Morningstar analysis. Tell me about Cisco, because it's another day where the stock's getting hit while everything's up. Is that appealing to you?
Yeah, I think that you can slowly buy into some of this weakness. I mean, the big thing that's happened with Cisco, look, it's looked at as a legacy technology stock. The SPLK deal has not certainly been accretive at this point, but we're starting to see some movement when you really dig into the weeds. I mean, large cap enterprise is actually up about 2%. So at least it's moving in the right direction. They're actually seeing nice movement on the cloud side. Cloud's actually up about 10%. So it may not add a lot to EPS in 24, and certainly as you're looking at the third quarter. But we think we're going to start to see it in 25. And as people see that at a 12 PE compared to what you're looking at in technology overall, look, all it needs to do is get back to a market PE, and you've got a huge run in this stock, and you're getting paid to wait a little bit. At 46, you're getting 3.5% in dividend yield, which for an individual is only getting taxed at a max of 20%. So it's not a bad place to hang out and deploy a little bit of money and for something that's severely undervalued.
Okay. How about in the energy space? You got a few other picks there, CTRA and EMR. We talked the utility trade earlier. Is this a power approach or is this an energy transition approach?
Well, I think for Coterra, at least in the energy space itself. I mean, they're an exploration and production company. They have gas that's in the Marcellus Basin. They have a lot of oil that's in prime territory they have in Permian. They're just a very low-cost producer. Their earnings are very, very consistent, consistently strong into CapEx deployment overall right now. We actually think it has about 40% of upside, very, very significant. Again, getting a 3% yield while you wait. Emerson on the other side, there we look at that as getting some play in the industrials. Actually, the energy and the industrials are, right behind utilities, and then obviously tech is outpacing this year. But they've had a good year, and Emerson, the CEO, is breathing new life into it in an industrial area that largely has zero growth for a sector. They're seeing 9% organic growth. I mean, so this is an entity that we think it can get up to at a 20 PE. It's a $130 target for us.
All right. And that one's got some momentum behind it, too. So seems like it's got to hit something for you, either the payout with the dividend or the momentum behind it. But both good names for us to watch here, and Cisco, too, going into the discount barrel or the doghouse, maybe. So we'll keep our eyes on it. Dan, great to catch up. Thank you very much for being here.
All right. Good to be with you, Oliver.
Thank you, sir. Dan Genter, CEO and CIO at Genter Capital Management.